Let's say a U.S. citizen, individual A, forms a foreign corporation, FC, in country X. FC is wholly owned by individual A, and it is therefore a controlled foreign corporation, or CFC. Individual A contributes cash of $1 million into FC on January 1. FC uses the cash to start a business in country X. FC purchases land with a building for $800,000. The land is worth $100,000 and the building is worth $700,000. FC also purchases equipment for $100,000. The remaining $100,000 of cash contributed is used by FC as working capital. The average tax basis of the depreciable tangible property of FC, i.e. the building and the equipment, during the year is $770,000. FC has no debt and pays no interest expense and has no interest income. During its first year of operations, FC earns after-tax profits of $120,000. None of FC's income is excluded from tested income. FC is the only CFC owned by individual A. FC's tested income for the year is $120,000. Individual A's net CFC tested income is also $120,000. FC's QBI for the year is $770,000. Individual A's deemed tangible income return, or DETR, is $77,000, or 10% of $770,000. Individual A's net DETR is DETR minus specified interest expense. Since FC had no interest expense, individual A's pro rata share of tested interest expense was 0, and specified interest expense for individual A was also 0. This means that individual A's net DETR is simply equal to DETR, or $77,000. This makes individual A's GILTI inclusion amount $43,000, or $120,000 minus $77,000. Let's change the facts a little bit. Let's say everything is the same except that individual A only contributed $500,000 of cash and that FC borrowed from a bank the other $500,000. The interest rate on the loan was 6%, so that FC's interest expense during the year was $30,000. Before, FC had earned after-tax income of $120,000. Now, with the $30,000 of interest expense, FC only earns after-tax income of $90,000. Thus, FC's tested income is $90,000. FC's QBI remains at $770,000, and individual A's DETR is $77,000. However, in this case, FC had tested interest expense of $30,000. Individual A's pro rata share of the tested interest expense was $30,000. Since individual A had no tested interest income for the year, individual A's specified interest expense would be $30,000. Therefore, individual A's net DETR is $47,000, or 10% of QBI, $77,000, minus specified interest expense, $30,000. Individual A's GILTI inclusion is still $43,000, or $90,000 minus $47,000. Thus, individual A's decision to have FC borrow a portion of the funds needed to operate FC's business did not change the GILTI inclusion amount to A.